What is going on, everyone? Welcome back to another video, another day, another dollar with your boy. And we're going to be breaking down our futures contract, looking at the S&P 500. And today we're just going to kind of review what kind of wacky situation we were in. Uh, it was a weird start for the bulls, but overall, still positive news. If you watched yesterday's video, we discussed on what we needed to see the bulls or the buyers do, right? We wanted to see the buyers remain within the upper distribution or open up within it or above it coming into today if we wanted to continue to see higher highs and higher lows, right? That's what we want to see in a market that is trend, in a market that is one time framing up on all three time frames. That is the big three, right? Whenever we talk about all three time frames, I'm talking about the big three, right? I'm talking about our monthly time frame. I'm talking about our weekly time frame, and I'm talking about our daily time frame. That's when trading becomes more accommodating, and that's when you get the most bang for your buck. Is whenever all three time frames across the board kind of line up, and then will help you create a better thesis moving forward, right? On how you should be trading, right? Um, in yesterday's video, I was discussing how we should not have been trying to short this market, right, on the grind up. Now, what we're looking at right now is my 30-minute chart, bar chart on Thinkorswim, and then I also use Tradeovate profile, market profile, TPO, whatever you want to call it, on the side, as well as their platform to trade within. Okay, so both align to be the same thing, whether you're looking at a 30-minute bar chart, 30-minute candlestick, whatever it is, it all results to be the same thing. Um, it's just a little bit more visually pleasing whenever you can look at the market profile on Tradeovate. So if you can use something or a tool or a platform that allows you to use that tool, it helps kind of bring things into better perspective. So if you can somehow manage to find a way to like utilize either Thinkorswim or a platform like Tradeovate to have your larger time frame, your 30-minute time frame look like this, it'll make things a lot easier as far as trading goes. So let's go back to the main point. All right, today we opened up with a gap to the upside, higher value, and things were looking pretty solid for the buyers, right? We had higher value, gap to the upside. Not only did we gap and have higher value on the upside, we took out the overnight high. Now, those are usually three things that lead to buyers being very comfortable in their positions. It also leads to a push higher. And we kind of seen that initially in A period or in the first 30-minute time frame of today. We kind of seen that, but then we ended up getting a little bit of a pullback or an inventory correction or adjustment, however you want to look at it, inventory adjustment, pulled back, which left us with, for the good part of the day, a set of single prints. Now, if you're not familiar with what a set of single prints look like, if we zoom right here on yesterday's profile, you can see where there's like little bitty gaps. Now, some people on like the smaller time frames look at like the 1 minute, say the 5-minute time frames. Some people use that and say it's a fair value gap, whatever it is, however you look at it. It doesn't matter whether you call it a fair value gap or if you call it a set of single prints like we do in the market profile world, specifically whenever you're looking at a 30-minute time frame. That is usually indication of what we call trend days. Now you can have a trend day up, but it's more powerful whenever you have single prints involved. So you can kind of see this little gap right here between C and E period, how we had this little bitty gap there. Same thing between E and G period. You had a little bitty gap right there, right? That was in indication of a trend day up. And today we had that for a good part of the day. I split this profile and we just look at today's price action between A, B, and C period. We had a little bit of a single print and trend day to the downside, which causes for confusion in the market, right? It's hard to want to be long whenever you're one time framing down, meaning we took out the previous time frame's low, we set a lower high, lower low, and then we hold trend in C period, set a lower high and another lower low, right? So that's showing that sellers have some type of control. Weak buyers are getting out of this market and we're pushing lower. Okay. Now, whenever you see this with higher value and a gap, it's very difficult to want to take a long position. It's also difficult to take a short position because you don't know if the trend's going to continue to hold because the market has been so bullish. So whenever you have mixed market generated information, or you're fighting on whether or not you should be going long or whether or not you should be going short, or you find yourself doing both back to back and losing on both trades, that's when you just kind of step back from the market and wait and see what happens, right? Now, this is when trading market profile kind of gets cool. All right. So yesterday we knew we had a triple distribution day up to the upside. We knew we had today higher value and we got the overnight high. So the odds of us taking out the overnight low at the same time was going to be pretty slim. We know a lot of the times that gaps don't hold in this market. So looking for the gap fill on the short side was not a bad play. Now, once you got that gap fill, it was more or less like sellers kind of trying to push this. But once you stop the one-time framing down, it was kind of giving you vibes that maybe we can do a little bit of rotation and maybe take some longs against the low. And we kind of seen that in E period and in F period. But then we push back lower in G and in H. Now, one thing I want you to notice is how we push down into the upper distribution and back within yesterday's value and got rejected out of it. Now, how you can use market profile to help make you a better trader and understand things is whenever we're in a market like we have been today or have been the last few months, in a market that is very bullish, in a market that has been trend up, we look for rejection out of either upper distributions or value areas, right? Same thing on the downside. If you were to be on a trend day or a trend down and you had lower value below the previous day's value area and you got back into it, you don't want to find acceptance back in there if you're on the opposite side. So say you're a buyer, right? You've been waiting and waiting for the gap to get filled. You took the long once the gap got filled at 70 in D period, you got paid on the push back up. It rotates back lower. Say you get long 70, you're not confident, but you're a little bit more comfortable knowing that we stopped the one-time framing in E period, F period did nothing, and then G period we start to one-time frame down, but where the first time we found ourselves back in that upper distribution or back in inside of that value area, we got a rejection or a bounce out of it, right? And if you weren't comfortable taking that long in G period to fade it and come back in, another part of this is developing point of control, developing a wide point of control, areas where you find a wide or a good portion of the time frames kind of coming back to the same price. We've seen that around 75. So you knew at some point, if we did not hold trend in G period, that we would rotate back up to 76 at some point in the future. So if you weren't comfortable taking the long in G period against value and that upper distribution, then you waited until the next time frame. Maybe in H period, you see we couldn't take out G's low. In H period, you see the market kind of rotate back up towards the high, or not back up towards the high, but comes back up into value area. You can see that we were clearly rejecting out of that day's range. So you're like, all right, now I'm gonna get long. Let's say I'm gonna get long 70, put my stop below 66. I'm risking 4 points, and I'm looking for maybe a rotation back up to 76. And we're gonna look, we're long 70, we're gonna gain 6 points. We're going to risk 4 points to the downside, right? That trade worked. Same thing in I period. We pull back. You weren't comfortable getting long at the lows. You take the same long against 70. This time you're stopped 67. You're risking a little bit less. Rotation back up to 76. Boom, right? After that, it got a little bit confusing. You didn't know whether or not you should be shorting this market. There was some indication that maybe you shouldn't be shorting this market because of the rejection out of value high area and that upper distribution. and you kind of felt that maybe this market would squeeze back up and fill that set of single prints on the upside. So maybe that was your long. In the bigger picture, it wasn't a bad idea, right? If you look at what a lot of people say support and resistance, if we zoom out of this, right? Let's zoom out and let's just look at it from a very small perspective here. Like ignore that the fact that these are 30-minute time frames and just say that this area here that I have highlighted, which is the upper distribution, on any given day, I'm gonna highlight green. On any given day, you would call that support, right? We pulled back into what a lot of people call support. The way we view it in the market profile world is going to be upper distribution or back into value area. And then you've seen higher lows come out of this, right? You've seen rejection out of that, right? A lot of people, that's what you want to see. You want to see, all right, we pulled back into it. How does price react whenever we get into this range? Oh, we wicked up. Okay, not only did we wick up one time, we wicked up 2 times and stopped one time framing down. We pull back to the same area and we wick up again. So your idea at this point as a trader is maybe it's all right to get long around this 70 level. We pulled back into what we would call support in the technical world, but for the market profile world, we pulled back into value area and found rejection out of that value area. So we know that value high is somewhere near the single prints, and we know typically single prints don't hold whenever you have a trend day down and value that is higher. A lot of the times, whenever you see trend day to the downside and a higher value, that trend day is not going to hold. Not a good portion of the time. I would say somewhere around 60 to 70% of the time, trend days don't hold whenever you're have a higher value on the upside. So seeing this, you're like, let's get long, put our stops near the lows, and see if we get some type of rotation back towards where the single prints filled around 85. And that's how you can make bigger risk to reward trades. If you're a scalper, it's good way to get in and out of trades. Say you're buying near the lows, you get a push up, you scalp out a couple points, it comes back in near the lows, you're buying, you're scalping out. But if you're bigger picture and you like to swing a little bit intraday and let things ride, getting long down here and letting it ride and see, all right, maybe I get long a 3 lot near the lows. First target is going to be where we had point of control. Let me go back to this market profile. So let's say we get long in H period, a 3 lot. My first target on the upside is going to be 75 or 76, which was the point of control, right? We want to get out at least some money, right? We take a little bit of profit right there at 76. We hold on to another 2. We let it ride up. Let's say we get near East High. That's going to be another area. We're kind of near our initial or our main target, which is going to be 85. That single print fill. We get out another little bit in J period. It pulls back. And maybe you moved your stop up, right? Say your initial stop was at H's low. You moved your stop up to J. You got stopped out in K period, but nonetheless, you still made money on that trade, right? On the push up from, say you got long 68, that push up to 75, you took some off, you made money. It continues to push up, take some off 82, you made money, right? You're long 68, made money, it pulls back, you get stopped out 73, nonetheless, you still made money. Now, if you kept your stop at the lows or even at the value low area, you were still in this trade, and your main target, once again, was that single print fill at 85, and you made money on that trade, right? I'm not saying to get long whenever the market is pushing lower, but whenever you see clear as day, right, you see rejection out of that value area, rejection out of the upper distribution. We're not getting any type of acceptance, knowing that we had higher value, knowing that we had the overnight high and that the odds of getting the overnight low were pretty slim, and just kind of seeing right in this area. Let me highlight it for you guys. Hopefully you're sticking with me. If not, this is just cool to me. So I like reviewing it for myself. But just seeing right here, I mean, right in this area, You see a Y point of control in the overnight session right there. A lot of accumulation was done right in this area, right? So you see that and you're like, you don't want to be shorting into this. You want to get long. You know that the daily's up. You know that the weekly's up. You know that the monthly's up. Got higher value. There was absolutely no reason that anybody that wanted to get long in this market shouldn't have gotten long. Now, like I said, getting long on the way down when you're one-time framing down and holding trend into the gap is kind of tough. So is getting short because of those reasons. But the main key takeaway here is after seeing an E period, we stopped one-time framing. We pulled back. We filled the gap, seeing the rejection, right? Maybe we want to wait until, say, H period. We see the rejection in H period. All right, let's get long on a pullback anywhere near those two lows. So in I period, it pulls back. We get long. Boom. Right? Now, it's not going to work all the time, but that's just a cool way to use market profile, use value area, use what's the word I'm looking for? Use distributions, right? It's just a great way to look at the market from that perspective. So what do we look for going into tomorrow? Okay. What do we look for going into tomorrow? Well, today was a bit of a nothing day. Nothing really happened. We opened up with a gap, got filled, and then we kind of just rotated. It was initially a nice B shape for long liquidation, but ended up turning into a whole lot of nothing. We do have a Y point of control. 1, 2, 3, 4, 5, 6, 7, 8, 9. We got a 9 Y point of control right around 76. Let's just say 76. That is going to be your Y point of control right there. I'm going to do the split. But nonetheless, today is more or less a weird bell-shaped curve. So tomorrow, what do we look for? Well, let's once again see if we hold today's lows. That's going to be the main takeaway, right? If we hold today's lows going into tomorrow, that's what the buyers want to do. They want to hold today's lows. If we do not hold today's lows, we will come back into an initial 3-day balance, depending on how far we pull back. And then your targets on the downside become those distributions from the 12th, from Tuesday, right? Hopefully that makes sense. So buyers want to hold this. Other than that, sellers have absolutely no reason to hold the highs. There's no reason to be selling up there. So if we open up with higher value, an inside day at all, hopefully we can push above 6,500, set new all-time highs, and get a little bit more of a accommodation day. But because we are at all-time highs, volume has been pretty been pretty bad, and we might be due, for some type of consolidation in the short term. So I would not be surprised if tomorrow we end up with a whole lot of chop within this area, especially if we open up inside value and inside the day's range. We will most likely see a whole lot of chop between value high of 64.88 and value low of 64.70. See a whole lot of chop there. And if once again we take out today's low, which is 64.66, we take out that level, your next target on the downside is going to be the lower end of the upper distribution, which is going to be around 64.54. From that point, your next downside target is going to be 64.44. Next downside target from that point is going to be value low around 64.30. And that is going to be my line in the sand, key hold for bulls in the market. They want to hold 64.30. It took us forever to find acceptance back above that level. And I think it's going to be key that we hold that value low and 64.30. If we do, I'm not saying we're going to, but if we take out today's low and get some type of pullback. If we did see that level, that's a level that I want to see hold for me personally. Now, what I expect is most likely a little bit of consolidation, and hopefully push to the upside, considering we are up on all 3 time frames, daily, weekly, and monthly. So hopefully the grind will continue. We just get a little bit more of a push to the upside would be great. But hopefully this video helped anybody out there looking to learn market profile, see some nuances. There's a lot to dive into. If you want to learn more about it, go visit camelbacktrading.org. Paul Asmar on YouTube. Great mentor, great guide. Go check him out. Check out the trading room. Great group of guys in there. Can't say enough good things about them. But hopefully, once again, you guys found some type of value out of this video. And if not, leave a comment down below how I can do better. Leave a like. Please subscribe. And we'll catch you guys in the next one.